All right, it is 7 o'clock. Welcome everyone to tonight's presentation. We're going to go ahead and get started. Welcome to tonight. I know you're all used to having Quinn present over the past few weeks. My name is John Mantia. As a reminder, I'm the co-founder and one of the directors here at Parco. Quinn and our colleague Danny as well, a fellow co-founder, is also on tonight. They'll be answering any questions that you have within the question and answer window inside of Zoom. So please ask the questions there if you have any. As usual, we'll also be hanging around tonight after the presentation to answer any questions that you have one-on-one. We always like to let people know that there will be the opportunity to do so during those presentations or during the presentations. For those of you who are new, welcome. For those of you who have been to some of our presentations before, and I see some familiar names and faces, welcome back. We are Parco. A little bit of background about us. That stands for Pension American Retirement Company. And we do retirement planning and financial planning for anybody with a pension, but in particular, federal employees. We spend our time as a team helping our clients navigate the retirement process and their retirement plans, no matter what portion of their career they might be in. For some people, they're just starting out. I have a couple of clients who were recently just hired with the federal government, want to make sure that they're well prepared for the future. Sometimes it's people that are in the middle of their careers and wanting to make sure that they're on the right track. And then oftentimes we're speaking with people who are nearing the end of their careers, nearing retirement, and want to make sure that they have all their plans properly in place to make sure they're excited and well positioned for this next stage in their journey. Wherever you are, we're more than happy to help. You might have seen us featured in a couple of publications. We've been picked up by more and more different places that are hearing about what we're doing. Places like Wall Street Journal, Forbes, US News and World Reports, different places like that. We do these webinars every single week, covering a different topic every other week. So tonight's presentation was based on feedback that we've received from surveys in the past. A lot of demand has been asked for tonight's topic. So as a couple ground rules, like I said, ask questions within the question window in the Zoom call. And then everybody on tonight's call will receive an email with a survey asking for your feedback, both good. I always love to hear, and we always love to hear things that are going well. But importantly, we always like to hear things that we could improve or topics that you'd like us to talk about in the future. These webinars, these presentations are meant to be valuable to our clients. Now, normally we expect these presentations to last between, call it 20 to 30 minutes. That's sort of our target timeline. Tonight's presentation is a little bit more dense. We're going to be talking about TSP distributions, the different options that you have, and which options make sense for you. We expect tonight's presentation to run a little bit longer. I'll try not to speak too fast because we want to make sure that you're able to absorb the information. And like I mentioned, we'll be around answering any questions that you have. It's an important topic. There's been some changes within the thrift over the past few decades with different fund options, with different distribution options. And so a lot of people have been asking us, hey, what options make sense for me as I enter retirement? How should I be thinking about this topic? And that's why we're talking about what we're going to be talking about tonight. So during today's agenda, first, we're going to go through some basic financial planning concepts. We call our financial planning process goal-based allocation. And we'll walk through what that means. And all throughout the presentation, having that financial planning architecture within your mind will really help you understand and help you put together the different distribution options that you have. Second, we'll go deep into the TSP's distribution options, the ones that you have available. And then we'll talk about the different stages of investing and how that can inform the way that your assets could be invested and what options might make sense for you. When we talk about accumulation and you're growing your assets, preservation, where you're having them around for use in the relatively near future, distribution, that's when you're using your assets, and then conversion, an often overlooked stage within the investment process, but vitally important, especially from a long-term planning perspective. So let's dive in and talk about financial planning and goal-based allocation. So what's helpful to keep in mind first is when a lot of people are thinking about their financial planning, they tend to think, hey, I have all these different goals that I want to achieve, and I have my assets, be it my thrift or my 401k or my IRA, and I'm going to achieve all those goals within this one investment vehicle. So I want to use it for supplementing my income and lifestyle in retirement. I want to use it to fund my trips abroad. I want to use it to give it to my grandkids when I pass away or my kids when I pass away. They tend to use it all as one big lump. At Parco, we break it up and we say, well, what tends to make more sense, in fact, is to say, okay, what are your goals? Start there. What are your whats, as we call them, and when do you want to achieve those goals? And then from there, we try to focus on finding the most efficient way, the most efficient place to achieve those. So for some people, and this is for a simple example, you may have the goal of supplementing your income in retirement. Maybe you want to take some trips and do some travel. Maybe you always want to have an emergency fund. Say you want to set aside money to, no matter what, at a drop of the hat, you have available to use it very liquid. And then legacy fund. So this is money that you may not plan to use for 20, 30 years because you want to leave it as a legacy behind your heirs, to your kids or grandkids. The way that you would prepare for and invest assets and invest your funds depends on these goals. A legacy goal could very well endure a lot of volatility because it could be exposed to higher potential upside. Whereas money that you're planning to draw on every single month to supplement your pension and your Social Security or your first supplement, you need to have that to be more stable. So the way that we would think through the financial planning process, and the way that we think a lot of clients find helpful, is to think, okay, we're setting aside a chunk of money here for income based on your goals and your pension and what you want, what type of lifestyle you want to live. Then based on your travel goals, we'll set aside funds for that. We'd set aside funds for an emergency. So whatever your emergency goals are, that would obviously be invested differently because it needs to be very liquid. The emergency fund isn't very useful if you can't access it readily. And then maybe you have a legacy goal. Hey, I want to leave $80,000 to my grandkids when I pass away. Well, the way that should be invested and how much money you need to set aside today to achieve that goal depends on the way it's invested and what you're planning to do with it. And then depending on what your goals are and the assets that you have, that can generate a fund money pool or what we might otherwise call a surplus. If you don't have enough assets, well, that generates a deficit. Then we have to play around with those numbers to figure out what those imply. But all these things are working together. And obviously the time horizon is very important. A legacy goal you're not planning to use for 20 plus years. Well, as if you're imminently planning to retire, you may have a plan to take money out of your tax deferred accounts very soon to supplement your pension. Your emergency fund, you may want to have that always available. So that's got to be there. Whatever these goals are, we always say, well, what's the what's and what are the whens? And then from there, we can craft a course of action. So with that framing in mind, now let's talk about the different distribution options that you have as a federal employee or as a federal retiree when it comes to your thrift. Your thrift is effectively your 401k. So an important thing to know, and we run into this oftentimes, is that a lot of clients will tell us, hey, I can't retire until I'm 59 and a half. And we'll say, well, that's a strange number. Why would you pick that? And they'll say to us, oh, well, that's because I can't touch my TSP until I'm 59 and a half. Well, that's not the case. There's something called the rule of 55. This applies to all 401ks, any employer-sponsored plans, which the TSP is one of. And it states that so long as you separate from service, and a retirement counts as a separation from service, so long as you separate from service on or after the calendar year that you turn 55, you can access your 401k, your TSP, any sort of employer-sponsored plan, completely penalty-free. So you can take a distribution from that account and put it right into your bank account and use it to supplement your income in retirement, completely penalty-free. This is particularly important to know for people who are planning to retire on, say, an MRA plus 30 retirement. You've hit your minimum retirement age. I spoke with a client today. She's 57 years old. She has 32 years of service. She'll be able to access her funds, and she knew about the rule of 55, but had she not, that might have materially impacted her plans for retirement. So with your TSP, you can touch the money as long as you separate from service on or after the calendar year that you turn 55, if you are under age 59 and a half. When it comes to your distribution options within the TSP, you have four main options. We're going to go through each of these in detail in just a moment, but they're systematic withdrawals, lump sum, so a lump sum withdrawal, the MetLife lifetime payment, and then an IRA rollover. So let's break these apart one by one. Systematic withdrawals. So when you take a systematic withdrawal, this is where you're instructing the thrift, you're instructing TSP to say, hey, I want to take out a regular amount monthly. Important thing to note is that you can only change the amount that you're taking out every month once every 30 days. So you can tell them, hey, I want to take out $400 per month. If you want to update that, you can only update that number once every 30 days. Further, such withdrawals are subject, and just like lump sums as well, are subject to an automatic 20% tax withholding. Now, this can be very important. In retirement, most people are in a lower tax bracket overall, or in a lower gross income tax bracket. So oftentimes, if they're taking out this 20% automatic tax withholding, that's an over withholding. Now, I know some people will say, oh, well, that doesn't really matter because I'll get that money refunded to me when I file my taxes. Now, you and I can debate whether or not it's advantageous to give free loans to the government, but even that aside, yes, it's true, you will get that money back. However, you can't put that money back into your thrift and have it growing in that tax advantaged, tax deferred way. So that automatic 20% tax withholding can be a big problem and something that definitely should be considered as part of your distribution strategy. Next is lump sum withdrawal. So this isn't a systematic withdrawal. This is where you instruct the thrift, hey, I want to take out $50,000 this year. This is a lump sum. Now, what's important to know about any sort of lump sum withdrawal from any sort of retirement account, but particularly from your thrift, is that can have big tax implications because the IRS is going to say, hey, you had a great year this year. You took a lump sum withdrawal for an extra $50,000. That extra $50,000, if it came out of your traditional TSP, it's going to count as income for your income tax purposes. So you're going to owe a tax bill on that. And depending on how much other income you have coming in, you could end up owing a lot in taxes. It's also subject to the automatic 20% tax withholding with the disadvantages that we mentioned before. The third option you have available to you is called the MetLife lifetime payment. This is the number, I know the annual TSP statements came out a few months back. For those of you that might have one handy or who have one fresh in your mind, this is that number that you see on the front of your annual TSP statement that says something like you could have $1,800 a month for the rest of your life, $2,300 a month for the rest of your life, $900 a month for the rest of your life, whatever that number says. Well, if you elect that option, that's you trading in your balance or surrendering your balance, effectively selling your balance to MetLife, the underwriter of FEGLI, in exchange for a lifetime income payment. So they will pay you that lifetime income payment, but you no longer have that asset that you've accumulated over the course of your entire career. So I've not seen any clients elect that. And if you do elect that option that's on the front of that TSP statement, you can't leave the remainder to the beneficiary. So it is an option available to you, that MetLife lifetime payment, but we seldom see clients elect those. Fourth is you can do what's called an IRA rollover. So when you do an IRA rollover, you're saying, hey, I want to move some money outside of the TSP into an IRA. When you do that, it remains tax qualified, or it stays in its tax deferred status. So a rollover does not trigger any tax implications. But there are some important things to keep in mind when you do an IRA rollover. One of the drawbacks is that IRAs, you can only withdraw funds out of an IRA after age 59 and a half. That's important to note. However, many clients elect to move into an IRA because they like the investment options that they have, the thrift, and we're going to talk about some of the thrift's funds here in just a moment. It's excellent because it's nice and simple. There's 5 core fund options and the L funds, which are just a combination of those core 5 TSP funds. However, some clients say, hey, I want to have more investment options. I want to be able to invest in different ETFs or different products. And IRAs tend to give you a lot more flexibility with whatever investments you want to go into. And then also you have more discretion. You actually have complete discretion over the tax withholdings from distributions from an IRA. So those are the 4 main distribution options that you have available to you as a federal employee and as a federal retiree within the thrift. So having talked about that, now let's talk about the different stages of investing. So we break the stages of investing into 4 different stages. There's the accumulation, preservation, distribution, and conversion stage. So from a high level, the accumulation stage, this is where you're in the middle of your career. You're growing your assets. The preservation stage is when you've done your goal-based allocation, you've done your financial planning, you've broken your assets up and you said, hey, I'm setting aside these dollars, and you're starting to get close to achieving those goals. So now you want to preserve that wealth to make sure it's available to you when you want to use it. The using it stage is the distribution stage. That's when you're starting to take funds out of your account and actually using the funds that you've accumulated over the course of your career. The conversion stage, like I touched on earlier, it's often overlooked, but this is the process of converting some or a portion of your tax deferred assets into a Roth IRA. We've talked a lot about Roth conversions a lot at Parco. We're going to talk about it more tonight. That's something we talk about with almost every client. It's an important strategy to give yourself even more financial flexibility, particularly as you are in and enter retirement. So first, let's talk about the accumulation stage in more detail. So sometimes the random transitions they keep me on my toes. They keep us all on our toes. So during the accumulation stage, again, you're accumulating. This is throughout the course of your career, and the TSP is a wonderful accumulation vehicle. First and foremost, you have a TSP match, which effectively looks like a free 5% of your salary that goes into your TSP that you have available to you. It effectively looks like a 5% match. The way it breaks down, there's a 1% agency contribution that you get regardless of whether or not you're contributing to the thrift. So we've actually had clients that never contributed to the thrift in their life, but actually had a TSP balance because of that 1% agency contribution. Then there's a 3% dollar for dollar match. And then there's a 0.5% match for each dollar above that up to 5%. So it looks like a 5% match. We tell every client that we speak to that they should at least be contributing 5% to their thrift because it's free money. An important thing to keep in mind that we always like to point out, that if you're not planning to retire in a given year, always make sure that you're putting in at most $1,000 per pay period into your TSP. I have some clients that are, let's say in their mid 40s or early 50s, not planning to retire for a while, and they say, oh, I'm putting in all my TSP contributions in the first quarter this year. I say, I love your enthusiasm, but if you do that, the TSP match doesn't work the same way. The TSP match only works on a per pay period basis. So now, if you're retiring this year, then it works a little differently. We can optimize for that. But if you're making regular contributions, always make sure that you're only doing up to $1,000 per pay period, as long as you're over age 50. If you're under age 50, you can contribute up to $19,500 per year, which I think breaks down to $750 per pay period. That's how that works. Another very important thing to consider during the accumulation stage is just the power of having time in the market, having years invested. So I know we've touched on this before in prior presentations, but it always stands out to us how important time in the market is. So this shows an example of somebody who puts $200 per month into their savings, growing at 5%. So if you're investing for 45 years, that you've put in $108,000, but it grows to almost $400,000 after 45 years. The less time you have in the market, those returns really, really reduce. Notice the big difference between 45 and 35 years, because you're missing out on those opportunities for that compounded growth. So it's always important to get started sooner rather than later when it comes to accumulating assets for the future. Now let's talk about the preservation stage. So we've accumulated assets, you've accumulated assets throughout the course of your career, you're approaching retirement, or you're approaching being able to achieve your various financial goals given the assets that you've accumulated. Now let's talk about the preservation stage. And this is where, as you get closer to retirement, your risk tolerance tends to shift more to more conservatism, because you're going to be harvesting your funds soon. You want to have them available for use in the distribution stage. During the accumulation stage, you can take a lot more risk because you're not planning to touch your assets for a while. During the preservation stage, you tend to tilt more conservatively because you're planning to use those assets relatively soon. When it comes to the TSP's different fund options, Like I mentioned before, there's five core fund options. There's the G and the F fund. So there's the government bond fund. There's the F fund, which follows corporate bonds. There's the C fund, which follows the S&P 500. There's the S fund, which follows the Dow Jones Small Cap Completion Index. So this is small cap stocks. Then there's the I fund, which is the international fund. It tracks the MSCI EAFE index. So Europe, Australasia, and the Far East. So it's an international index. The L funds are some combination of those five core fund options, with the L income having a higher allocation. In fact, 76% of the L income fund is tilted to the G and the F fund, whereas for the life cycle funds like the L2055, L2060, and beyond, they're heavily tilted toward the C, S, and I funds. Now, especially when considering the preservation stage, a lot of clients and distribution stage, a lot of clients look into the G fund, because the G fund is the only fund within the thrift that is not subject to any downside risk. It's not exposed to the market. And we're going to detail the G fund more in this presentation in just a moment, and then we're actually doing another presentation diving deeper into the G fund in a couple weeks. But the G fund is special because it's super, super safe. You can't lose money in the G fund. It is completely free from downside risk. Now, the way the G fund works is that it tracks U.S. government interest rates. They actually basket over 100 interest rates. And then the Treasury issues special securities yielding that blended rate. The government can borrow from it. I know that every time the government runs into a debt ceiling issue, there's always concerns that the government will be able to borrow from the G fund. And the fact that they can borrow from it means that it has a lot of the qualities of a bank account, because it's super, super stable. And it's these highly liquid securities that the government can borrow from. However, you are getting an interest rate that tracks U.S. government interest rates, and it is super, super safe. Now, one of the things that's happened in the government securities market, in the government interest rate market, is that yields have fallen a lot over the past several decades. This shows the average yield on the U.S. 10-year Treasury over the past several decades, and you can see how that's declined. Basically been in straight decline since the 1980s. There's a lot of things that are factoring into this. Aggressive monetary policy, particularly since the 2008 financial crisis. Global central banks have been big buyers of government treasuries, of U.S. treasuries in particular. So when they buy these bonds, they push the yields down. So the yields have gone way down. The G fund, which tracks government securities like the 10-year Treasury, like the 30-year Treasury, like the whole blend of treasuries, has seen its yield fall as well. Back in the early 90s, right when I was born, the G fund was yielding almost 9%. Throughout 2020, the G fund yielded 0.97%, and so far this year in 2021, it's returned 0.27%. So yields have shifted down quite considerably over the past several years. We always like to show this chart about how the G fund, while very, very safe and stable, this is over the past 15 months, $1,000 invested in the G fund would have grown to $1,000 and $1,012. Now, it's nice to have a positive return, but of course, that's not even keeping up with inflation. So while it is very stable, it's not returning a whole heck of a lot. Now let's talk about the distribution stage. So we've talked about accumulation, we've talked about preservation. Now let's talk about distribution. So this is when you're starting to use your assets. You're actually going to be putting them in place. And so a lot of people, especially when it comes to distributing from their assets or setting aside assets to use for income and for lifestyle, and to take regular distributions out to supplement their pension and Social Security in retirement, use what's called the 4% rule. And the idea is that you're basically taking out 4% of your balance every year, and hopefully the growth that you're getting within your account plus your age means that you're never going to potentially run out of funds. That's where the 4% rule comes from. Now, the 4% rule was created in a time when interest rates were relatively higher. So a lot of people are questioning it now, but it is a good rule of thumb to use. And so to illustrate, the power of, not only just the 4% rule, but also the opportunity cost of not investing in something that's growing more. So I guess maybe putting it another way, the opportunity cost of investing in a low return asset. we've got two graphs we want to show. The first shows the value of $300,000 growing at various interest rates, assuming no withdrawals are taken out. So no matter what, the account balance grows, but depending on the growth rate, it can grow. At 6%, it grows to over $3 million over the period of 40 years, whereas at a 1% interest rate, it barely grows to $400,000 after 40 years. So while it does grow, it doesn't grow very much. Now, when you start taking withdrawals, all that math changes. This is that same $300,000, but assuming a 4% withdrawal rate, $12,000 annually withdrawn. Assuming these different growth rates, what happens to the funds that you have available to you, assuming certain growth rates? And you can see how even at at a 1% and 2% and a 3% growth rate, your funds start to get pretty steeply exhausted. At a 4% growth rate, you're breaking even. And at a 5% and 6% growth rate, you're actually making money over the long term while still taking money out of your account. So the challenge with the G fund in particular and the 4% rule is that the G fund hasn't been yielding that 4% amount over the past several years. So a lot of people they might move their money into, say, the G fund or even the F fund during the distribution or the preservation stage of their investing, they're not getting the returns they need because the G fund's just not getting those returns. And further, something else to touch on is that the TSP does have some fees associated with it. Historically, the TSP's funds fees were the lowest in the world. And now they are still very, very low, but times have changed. While the average fee on the TSP's funds are less than 5 basis points, 0.049%, back in the day, that was hard to get anywhere else. But a lot's changed over the past decade or so. There have been many different offerings from different ETF companies, different investment companies that now offer fees that are either comparable to the TSP or even lower. Some Schwab, some Fidelity investment accounts or investment options don't have any fees associated with them at all. This is a big deal. This fee compression has been a big theme in finance, in the financial markets over the past several decades. And it's definitely informed how people consider the TSP when evaluating it compared to other options. For instance, some of the private market alternatives, particularly like the AGG, the IVV, and the SCHA, which are very close analogs to the TSP's core funds. The AGG is a great analog to the F fund. The IVV is a perfect analog to the S&P 500 or the C fund. And the SCHA is a very close analog to the S fund. Those all have fees that are actually less than the TSP's core funds. We could not have said that a decade ago. We might not even be able to say that five years ago. So the point is that if you are looking for similar investments that are available to you within the thrift outside of it, many exist now, and even on a fee controlled basis, many exist now. So in the distribution stage as well, something else you need to consider is volatility, the volatility of your assets. This graph shows two return streams. They're both exactly the same return streams, but one, the blue line, is the exact same return stream, whereas the red one has the same average rate of return, but it fluctuates around a lot. There's some negative years there. And that fluctuation can matter a whole lot when you're taking distributions out of your account on a regular basis. That's what we call that sequence of returns risk. When you have a long time horizon and you're not planning to withdraw funds out of your account, the volatility doesn't matter nearly as much as the average rate of return. In fact, all that matters is the average rate of return. The volatility doesn't matter at all. However, when you start taking funds out, that changes and volatility matters a lot. And let's show why that's the case. So some of you may have seen us present this graph before, but this shows a $200,000 investment in the S&P 500 over the past 20 years. So starting back in 1999, $200,000 grows over the course of 20 years to $648,000. This is the real returns the S&P had. Then what we do is we say, well, let's take those returns and let's sort them from best to worst. So the best years happen first, the worst years happen at the end, but we don't take any withdrawals. Well, what happens? Well, great years happen at the beginning. Account balloons really high, but then the bad years happen. and it converges down to that $648,000 number. So even though the best returns happen first, the last returns happen at the end, since the average return is the same, it converges to that same number, just under $650,000. Well, hang on. What if we took instead the worst returns first? And the worst returns happen at the beginning and the best returns happen at the end. What will that look like? Well, it converges again. It obviously dips very low, but then those great years start to make up for it and they compound, and then it all ends at the same value, that $648,000 number. All these return series, the green line, the red line, the blue line, all had the same average rate of return over that time period. That makes sense because the client, the individual here, is not withdrawing funds out of their account. However, once you start actively withdrawing funds from your account, you're selling your balance. You're taking portions of your account out every year. So those funds that you've taken out can't compound in the future. And that has major impacts. And that's why when taking regular distributions out, the volatility matters a whole heck of a lot. So assuming a $200,000 initial investment with an $8,000 annual withdrawal, the ending balance is $305,000. So it's still invested in the S&P 500. This is just what would have happened over that 20-year time period. So the beginning balance is less than the ending balance, but you're taking money out along the way. If we do the same thing like we did before, we flip the return series. So the best happen first and the worst happen at the end. Well, the ending balance is a great deal higher. And that makes sense because during these periods of dramatic upswings, when you're taking out a regular $8,000 per year to supplement your lifestyle and retirement, that $8,000 is a much smaller percentage of your overall balance than it is than it otherwise would have been in the blue example. So because you're taking out a smaller percentage of your balance, the rest of your balance can grow more. So the ending here is $552,000, over $500,000. Now, while we all would love to have the green line happen, what we really want to avoid is the red line. And the red line is where the worst returns happen at the beginning and the best returns happen at the end. And you can see over the 20-year period that the account is entirely exhausted. And that also makes sense because a bad year happens right at the beginning and you take out a fixed amount. Well, you've just sold a huge percentage of your balance relative to what it otherwise would have been. So that's why a lot of clients get very concerned about downside, particularly when they start taking money out of their account, because those distributions can have a really outsized impact, especially if you're exposed to a lot of volatility. And when thinking about G fund alternatives, which avoid different types of volatility or avoid, the trade-off of the low interest rate that you're getting within the G fund, but also having that safety, there's a couple different options people consider, be it high interest savings accounts from places like Marcus, be it certificates of deposits that people look at the bank, be it a bond laddering strategy. So we know many clients who employ or who look to employ or speak with advisors who employ different laddering of bond strategies and then just harvesting those and rolling them up, be it fixed income bond ETFs and mutual funds. Which were more popular back in the day, but the yields on those have obviously declined a lot. And oftentimes also we're seeing clients look into the insurance market and fixed index annuities, where they're sacrificing some liquidity, but getting that bond-like return there as well. We're seeing more and more people talk about that too. Now let's talk about the conversion stage. So the conversion stage is something that's been happening all across these various stages. And the conversion stage is where you're converting assets from your traditional, from a traditional qualification into a Roth qualification. And important thing to note is that with almost every type of tax qualified account, special account, the IRS has RMDs, or required minimum distributions, where they state that you have to start withdrawing your funds out starting at age 72, because Uncle Sam wants his money. So recently that was raised, thank goodness. It used to be 70 and a half, but now it is 72. So you do have RMDs coming down the pike, and that's something that we're going to be talking about in a future webinar as well. Now, most retirement accounts are subject to RMDs. Your traditional TSP, your Roth TSP, and your traditional IRA, those are all subject to RMDs. You have to take have to take RMDs out of all those accounts. Even a Roth TSP, you have to take RMDs out starting at age 72. But a Roth IRA does not have any RMDs at all. This is an important point because then you don't have to start taking money out of that account in the future. Another important point, we like to think of this as the best kept secret, and I think Parco is probably the biggest advocate of Roth conversions around. There's no limit to how much you can convert into a Roth IRA. And a Roth IRA conversion, and I'm probably repeating myself, is the process of converting a portion of your tax-deferred assets, typically a traditional IRA, into a Roth IRA. Now, the reason why this no dollar limit on Roth conversions is important is that there's typically a contribution limit, be it $6,000 or $7,000, depending on how much or depending on how old you are. Whereas with Roth conversions, there's nothing that stops you from saying, hey, I want to convert my entire tax deferred assets over into a Roth IRA. There's nothing in principle that stops you from doing that. Now, from a tax planning perspective, that might be inefficient, but you can do that. And that's very powerful. And again, that process of Roth conversion is converting that traditional asset into a Roth. And an important thing to note is that you cannot do a Roth conversion within the TSP. So this is something that we have a lot of clients ask us about. They say, hey, I want to do that Roth conversion. And we'll say, well, you can't do it within the thrift itself. So what you have to do is you have to move money from your traditional TSP into a traditional IRA. And then from there, you do the Roth conversion into a Roth IRA outside the thrift. That's the case with most 401ks, is that you can't do a Roth conversion within a 401k. The TSP works the same way. And it's something we help our clients with every single day. It's a key part of our strategies for our clients, especially when it comes to legacy planning and helping give them financial flexibility in retirement. I know I ran a little bit longer tonight than normal, but here's a copy of tonight's Works Cited. We're happy to share with whoever would like. In terms of some future webinar topics that we're going to be talking about, given where interest rates are and given some of the questions that we have as people are considering retirement a lot more as the pandemic begins to open, we're going to be going into the details of the G Fund, which is the largest of the TSP's options, how it works. Then we'll be talking about RMDs, a straightforward look at a complicated concept. It's something that we find that many clients are really, really concerned about. RMD and RMD mitigation strategies. So we'll be talking about that. And then some other future topics like the veteran to civilian transitions, the disability retirement process, and then just overall talking about the retirement paperwork process. So I know I ran a little bit longer tonight, but this was a great topic for the people that have asked for it. We're so glad to be able to do it. And myself, Danny, and Quinn are looking forward to answering any questions that you have. We'll be here until we get everybody's questions answered.